I welcome you to this webinar from IMD. So good evening if you are in East Asia or down under. Good afternoon, India. I saw people from Sri Lanka, Lebanon, Middle East. A late good morning for those of you who reside in Africa or Europe. And finally, if you're from the Americas, go back to bed. Before I get into this, I want to say everything I do today is of second order importance. The most important thing is your health and the health of your loved ones. So I hope this message and the session reaches you safe and well wherever you are at home. So here's a quick overview of what I want to do. Given that you are in the session, I assume you're sort of following what's happening in the economy, on financial markets as a result of the coronavirus pandemic. Nevertheless, I thought, just so that you know what we're talking about, I give you a medley of statistics from equity markets, commercial bond markets, and some data from the real economy. Then I want to sort of explain why actually this crisis is much worse than it could have been otherwise because of some sins from the past. And this is a special for current and former EMBA students, AMC students, I want to sort of relate it to some stuff we are actually teaching and connect this directly to material from classes. And I want to convince you that actually there was trouble already in the economy, in the worldwide economy and financial markets before the pandemic. And because of some of these troubles and sins of the past, now we are already seeing first casualties and we're in trouble. And then if I have a little time at the end, I'm going to give you a brief outlook of where we think we're going, and hopefully I can answer some questions. So since Lausanne is in Switzerland, I thought we're going to start with the Swiss market index, the SMI. That's the stock index here in Switzerland of the 20 largest companies. This index actually reached an all-time high in February, only then in the following months to crash by more than 30%. So if you read the newspapers, financial pages, you have seen pictures like this here on the right, crashing. Now, another statistic, the most famous stock market index in the world, the Dow Jones 30 Industrial Index, even lost almost 40%. It was also at an all-time high in February. People were saying, okay, when is it going to hit 30,000? When is it going to hit 30,000? It didn't, it crashed, and I think we won't see 30,000 in a long time. Now, please don't be insulted if your country is missing. I just picked a couple from around the globe. We see here the top four are from Europe, the Swiss market index, the index in France, Germany, and Italy. And here you see in the first column the market index at the beginning of 2020, the high for most of them all in February, the low in late March, and yesterday's close. And yesterday was the high. So we see, for example, the French index lost 27% versus its high. The Italian index almost 32%. And then in the last column, I show you what has happened since the lows, and we have had a little bit of a recovery. In Asia, actually, the Shanghai Composite Index is doing comparatively well, lost less than 10% versus its high. The Nikkei was hit harder, 20%, and then finally we have the American indices. I could now drown you in more of these boring statistics. It's just so we saw markets crashing. Now, we have seen something else. And here, I must say, I'm a bit embarrassed that I'm showing you these numbers. I looked for a better source than Wikipedia. I looked at the Dow Jones website, at the S&P websites, at other financial websites. I couldn't find this data as nicely summarized as in Wikipedia. So my apologies. At the top, you see the 5 worst days of the Dow Jones percentage changes in its 140-year history. We have data on the Dow Jones going back to 1881, so almost 140 years. And now notice 2 of the worst 5 days in history came in March of this year. The worst day of all time is still the Black Monday in October 87, where the market lost more than 22%. You see here then 2 days during the Great Depression in 29. However, 2 of the 5 worst days ever came in March 2020. Down here, we have the 5 best days in the last 140 years. And again, 1 day in March is among the 5 best days, relative speaking, which is important here. If you look at the absolute changes, because absolute numbers are now much higher than in 87 or 30, 1930, of course, by absolute changes, we have seen the largest numbers ever, but that's not so interesting. So we see crashing equity markets with a bit of recovery, huge amount of volatility. Now, some of you may say, I don't care about stock markets. That's too risky for me. I'm a bond market investor. Here's what happened to bond market investors. This is an index in the United States of corporate bonds. Quick reminder for the non-finance people, corporate bonds is a way for companies to borrow money in financial markets. And usually this goes up a little bit. It's kind of boring. Here we see what happened in the last year with this index, and then kaboom. Yeah, the performance of these, and these are the high so-called investment grade rated bonds. So these are the assuming safe companies. Their prices took a hit. This is now not only in the US, it's also here in Europe. These are now so-called high yield bonds. These are bonds of companies with a lower credit rating, sometimes colloquially also called junk, and they also got hammered. Now, I realize that we have a very international audience here today. Why do I focus so much on, in particular, US data as we move on? There's an old saying on financial markets, if the financial markets in the US sneeze, the rest of the world catches pneumonia. Maybe not such an appropriate saying in the day and age of the coronavirus. However, whatever happens on US financial markets has a ripple through effect through the rest of the world. So whatever problems we see there, we see elsewhere, perhaps with a little delay, but we will see them elsewhere too. So corporate bond markets also got hammered. Now, this is financial market data. Let's look at the real economy. Perhaps the one number that a lot of people, that's big in the newspapers because it's so shocking, is unemployment in the United States. Now, we have to understand that the United States does not know the system of short time or short work hours that we have in many European countries, where the government pays part of the salary of people that get sort of cut down from 100% work time to 50% work time. The US doesn't know this. So their people are immediately fired. So we see huge rise in unemployment. At the end of last year, there were about 160 million people in the United States employed. Here we see the rise through the last 30 years of full-time unemployment was just above 130 million at about 30 million part-time employees. Makes 160 million. 6 million unemployed was an unemployment rate of about 3.5%. Current estimates, back of the envelope, calculation said late last week, 13% were unemployed. There are some people who are saying we're going to see unemployment as large as 30%. Now, behind this cold, naked number, there's tragedy. 13% unemployment means we saw an increase of 15 million people losing their job. If we see 30% unemployment, then in addition to these 6 million, we have more than 40 million extra. They are real human tragedies. This is from yesterday's New York Times online site, or maybe today's site. In the richest country on the globe, people go hungry each and every day. You see here a picture of a church giving out money, a food bank at a church. You see here a picture from Pittsburgh, outside Pittsburgh, people lining up for miles, hundreds and hundreds of cars lining up to get free food because people live paycheck to paycheck. So I want to clearly acknowledge, I know people in finance usually have a bad reputation of being greedy bastards looking at numbers. Let's not forget, when we focus on financial markets now, there is real tragedy. And if this is happening in the United States, we know it's equally worse in many other countries around the globe. Now, that's one. Unemployment is one way to look at the real economy. Here is a beautiful little chart from last Sunday's Neue Zürcher Zeitung, one of the leading newspapers here in Switzerland. The Neue Zürcher am Sonntag, so Sundays, and they had data on power consumption in Europe, electricity consumption. And we see electricity consumption is decreasing. The blue line is mid-February, when the economy was still going at regular speed. Then in the middle of March, we see a big drop. And then last week, we saw another drop. So what this now shows us that the real economy is slowing down. Companies, shop floors are empty. They cannot work, or they have to work with reduced number of people. So people are switching off machines. We have a decrease in power consumption. This is a great indicator to see how the real economy slows down. Now, here's one cute point I just want to point out. Look, typically these lines peak in the middle of the day. In the morning, companies start working, sometime into the evening, and then we have two extra peaks when there's food being served, when we need ovens. So we have always a lunch peak and a dinner peak. Now, this has changed in the crisis. Now the lunch peak is higher than the dinner peak. A lot of people are now at home doing home office, making warm lunches. Sort of kind of cute. You see how people behave differently now than in regular times. Now, in addition to the current data of the real economy, a lot of forecasters are interested in so-called sentiment indices. What is the current opinion of key decision makers looking forward? The European Commission has such an economic optimism index in the European Union. And we see here, it's kind of boring for the last year, going up a little bit, going down further, going up, and then kaboom. In March, it hits. And there's a big drop. And this number is clearly still inflated because the first week, 10 days of March were still okay. So likely we see even the forward-looking sentiment of decision makers, of managers. For example, purchasing managers are always very important because they make decisions on purchasing raw materials, inputs for the next couple a month, the next 2 quarters. So we see a big drop here as well. So to summarize, we see on financial markets, stocks and bonds dropping in prices. We have indicators of the real economy who show us a slowing down, unemployment rising, and even looking forward, the sentiment indices are tanking. Now, having said this, what's going to happen next? The OECD came out with an outlook in early March. And many of you, or some of you, may have heard about this V-shaped recovery, a recovery shaped like the letter V as in victory. We see a crash right now, but then once the pandemic is under control and we're allowed to go outside and work, go outside and shop and spend money, we're going to see a big recovery. Now, I'm sure by now the OECD no longer believes in this. Look, the minimal values here, whether it's for the entire world, for the advanced G20, the largest 20 economies in the world, or emerging G20, these numbers were still positive. That's definitely no longer true. Fitch last week came out with a forecast, and it's now saying we're going to see a deep global recession in the US, in the Euro area, and in the UK. Even China will barely grow. Now, China, the last couple of years, was always growing between 6 and 7%, brackets open, assuming we can trust their numbers, brackets closed. So from 6 or 7% to going under 2 is also quite a damper there. Yesterday, the economic advisors of Angela Merkel in Germany came out with their recession forecast for Germany, and it's in line with this -4%. So now, to summarize, we see deep economic recession in the US and Europe and many other areas in the world. We see weak, if any, growth in China. We see real human tragedy around the globe. I showed you, because it's in the newspapers from the New York Times and so on, record unemployment. And equity and corporate bond markets got hammered. That's the status quo. Now, with this behind us, let's now look at what's the top concern of companies right now, the top 3 concerns. And I took this from the IMD dean, Jean-François Manzoni, who talks to a lot of C-suite people. And think about what is number 1, number 2, and number 3 concern. It's cash, cash, and cash. Companies are running short on cash. Money is not coming in. And as a result, the question is, do companies have enough liquidity to make it through the crisis? And the answer is, many companies, the answer is no, they don't. And this is why we're talking about bailouts. Now, these bailouts, while we read about the big bailout in the United States and the discussions in Europe, this is happening everywhere. The country of Singapore bought a lot of shares in Singapore Airlines to help. As you all know, airlines have been hit really hard. Dubai is putting money into the Emirates. So this happens to the best, most prestigious companies on the globe. Now, before I go back to the numbers, I know that there's a good chunk of you who is not in finance, who doesn't care so much about finance. Does it still affect you? And the answer is yes, it still affects you. The question you have to ask yourself, does my company or your group, my division, have enough liquidity to survive the month of April, to survive April and May, if we cannot restart production, restart selling? So, and if you have these issues, what are your sources of liquidity? Can you give out new shares if it's a company? Should you take out loans? These kind of questions. Next, and this is a point that I will make repeatedly, even if you are in good shape, your company is in good shape, and you say, oh, I see we are crashing, but I'm optimistic on the V. Hold your horses. It's not so easy. Why? What happens if your suppliers are broke? Can you restart production looking at your suppliers? And that's a big concern. And when I now talk about suppliers, perhaps, and supply chain disruptions and crisis, I'm not talking about what we see right now. Oh, in Wuhan, they had to close down factories, and so China is not delivering what we had ordered. I'm not talking about this. I'm talking about even after the whole world, think about the following. Even if we get rid of the COVID-19 virus, if everything is back to hunky-dory, there is everyone still alive, these companies, to supply this. So, and then the question is, in the age of lean production and lean management of the last decades, do you have only one supplier for a particular item? Do you have 2 or 3? What's the risk management there? And finally, we will see a lot of perhaps M&A deals. Big discussion already among policymakers. Negative view of M&A deals is some companies are in dire straits. Private equity companies come in or competitors come in and buy them. Policymakers are worried that this may lead to market concentration, to oligopoly or monopoly power. They don't like this. So they are already in the European Union talking about how can we protect some of these weaker companies from being taken over. On the other hand, the positive view is maybe it's an opportunity for you or for your company to look for interesting M&A deals and acquisitions. These are just things to think about when we talk about these numbers. Now, Gordon Gekko in the movie Wall Street famously said, greed is good. And now I want to next talk about why the sins of the past, some bad behavior, some bad greed in the last couple of years actually makes the financial problems now worse. Before we do this, I'm looking at some question. EU consequence of the euro. We'll talk about this later. What's stock markets, real economy? Peter is asking about the stock market. I cannot believe the recovery we have seen. There's a lot of optimism in there, in particular in the United States. The S&P 500 is by official measures in a boom phase because it has made up 20% since the last low. There's so much money out there looking for investment, so much liquidity. That's the only thing I can think about. FX forecast, I'm careful. Vacislav, I will talk about this, the other questions I see here later. Thank you. So, in later context, good questions, all later context. So, now let's move on here, trying to understand this. So, this is a question. I know there are a couple EMBA students in there from my December 2020 class. You may recognize this slide. I showed this to you in office hours in February. And this headline from the Financial Times, the January of 2020 was borrower's paradise, and we saw a new record inflow into junk bonds. So we saw the largest inflow ever in high risk junk bonds. So these are called junk bonds. Why is this? And this is now a big step in explaining what has happened in the last couple of years. Interest rates were very low. For example, here in Europe, the interest rates on Swiss government bonds have been negative for quite a while. On German government bonds, very small or negative as well. Greece and Italy had very small interest rates on government bonds. Then Trump put a lot of pressure on the Fed to also lower interest rates, even though they had record low unemployment. It didn't make sense at all, but he thought he needs to heat up the economy to get reelected. So we saw these low interest rates, these low yields in government bonds. So those investors who were allowed to do, they went into commercial bonds and into more risky commercial bonds. So there was a flood of cheap money, going into these debt markets. And so now look at these. So January was a record month. So here, just as the market was at this peak, we see a record prices of these bonds, and then the market crashed and lost easily 20%. So the company, even though this is the total index return, total the high yield index total return. So these are on the junk bonds. These people who went in here, those record inflow in January, kaboom, 20% gone within 6 weeks. Hallelujah. Now, when these prices go down, what happens to interest rates? They shoot up. And now for all the non-finance people, this is important for your company because this will decide whether your company survives this crash or not. Now, back to the EMBA finance class to quickly review this. This is again a slide from my finance EMBA class where we learned that the bond value, the price of a bond, equals the net present value of the future payments. So for those who don't remember or never learned about bonds, the company needs a lot of money. Instead of getting a loan from a bank, they go out to financial markets and give out a so-called bond and get a lot of money. When they give out the bond, they have to say how much interest they pay. That's a coupon. That's fixed. That number is fixed throughout the whole time of this bond. In the end, they have to return the money, the so-called par value. This, let's say a company wants €1 billion, they cut this into pieces of 1,000 at a time. So now you or I, as a retail investor, we can buy this bond. I give €1,000 or dollars, whatever currency, yen, renminbi, what you want, and I get a coupon payment once or twice a year, and in the end, I hope to get the money back. Now, when the coupon and the par value are fixed, the numerators are fixed. Now, if the bond value crashes, what's happening on the right side? Since the numerator is fixed, the denominator has to go up. This happens in a ratio. The ratio goes down if the numerator goes up. So interest rates are going up. Why is that so? Now, at first, this is not important to a company. How can I explain this? Think about you buy an apartment or a house and you need a mortgage. You get a mortgage, you pay interest, let's say 5% for 10 years. Now, here in Switzerland, for example, when you get a mortgage, you amortize only a little. So after 10 years, you have to refinance your mortgage. In the United States and some other countries, there are adjustable rate mortgages, so-called ARM mortgages, where I fix my interest rate for 3, 5, or 7 years, and then afterwards it floats. Now, in the first couple of years, I don't care whether interest rates go up or down, because my interest rate that I am paying is fixed. It's fixed. However, once I need to refinance an adjustable rate mortgage, or here in Switzerland after 10 years, because I haven't amortized the entire and paid down the whole loan, then I care about interest rates. And so this is now the issue. Companies that do not need to refinance in the near future, they are fine. But companies who need to refinance their loans or because of cash crunch need to take out a loan, they suddenly have to pay much higher interest rate now than in the past. And then it's the question, can you still afford this? Can you still afford this? Can the company still afford to get out a loan at a higher interest rate? Now, why is this so important? Here's another slide from EMBA class in January. These bonds, you may have heard about the rating companies. Every company gets a rating that tells investors how safe this company is. The best possible rating are the so-called AAA ratings. From AAA to BBB is investment grade, good companies, safe companies, however, progressively worse. And then the so-called junk bonds, BB and up to CCC. Look what happened in the last couple of years. Historically, BBB was a small portion of all the good ones. However, a lot of companies loaded up on debt in the last couple of years, even those companies who were barely high yield. So as a result, we now have a ton of companies who are just here borderline high yield. And now some of them are now already shaky. And the market has already, those prices have crashed, those companies' yields are now higher, much higher. It doesn't matter yet for them until the moment they have to refinance. And so, can they refinance? This is also a slide from EMBA finance class. Briefly, I need one metric here, the so-called net leverage, which is the total debt of a company minus cash and short-term investments. So essentially think of a net dash relative to a finance or accounting figure EBITDA. Think of it as some version of cash flow. So this number has been historically here at around 2.5. At the beginning of 2020, the S&P 500 had this number at about 3.2. Yeah, things have gone up a little bit the last 2-3 years because people got out a lot of loan and so the total debt increased. But now we have companies such as, for example, Boeing, that has this number at 60. So the total debt of Boeing is 60 times this cash flow figure. Now, Boeing is not going to go broke. The US government is going to bail them out. Trump and Mnuchin, the Treasury Secretary, will shower Boeing with free money. It's ridiculous. Boeing, of course, was in trouble because of the 737 MAX disaster, of their bad engineering. They were cutting corners to save on costs because they were greedy bastards, excuse my English. But they were much worse, and I will show you that in a little bit. And there are other companies who have now a huge debt load. So to summarize, where are we coming from? I showed you at the beginning where we are, crashing markets, huge problems in the real economy. Now, how did we get here? We saw a huge demand for corporate bonds from central banks. You may have heard about the quantitative easing, the central banks buying bonds, and institutions. We had low interest rates for several years. Firms said, wow, money is cheap. Let me borrow like crazy. We saw crazy takeovers. There was huge M&A activity. Another topic that I could talk about for an hour. Don't have time about this. And then even companies with low profitability who didn't have a lot of cash flow could roll over their debt. Some of you may have heard the concept of a Ponzi scheme. Some companies were doing this. And this went okay because the economy was doing pretty well in many areas around the world. And now, kaboom. This is a new figure that came out, new data a couple days ago. Even the EMBA students, you have not seen this. So I told you, increasing interest rates are trouble when you have to refinance. Do companies have to refinance? Sad news. Yes. Look at this. So first, dark red means a company needs to, debt is due, and they have to repay the debt, and most of them refinance the debt in the next 2 years. Look at the United States. More than 500 billion US dollars need to be refinanced in these BBB. More than 40% of the junk bonds have to be refinanced in the next 5 years. In European bonds, more than 300 billion need to be refinanced very soon. Even in the remainder of the world, hundreds of billions need to be refinanced in the next few years. So a lot of companies who could borrow really cheap in January suddenly now have to borrow at very high rates. Now, in this report, they cite Morgan Stanley, saying that 1 in 6 US companies does not earn enough cash flow to cover interest payments on its debt. This term zombie company has been around longer. The first to come up with this was actually a report early last year. I believe I talked about this to the EMBA students. At the Bank of International Settlements here in Basel in Switzerland, they looked at what company have been doing. Money was so cheap, so these zombie companies are essentially bankrupt, if not for essentially running this Ponzi scheme and pushing out debt further and further. Now, then also they quote a famous finance professor, Campbell Harvey from Duke, who says, now, some of these many companies that are in trouble are crucial suppliers in big supply chains. Just to give you an idea of the magnitude. The second largest car manufacturer in the world is Volkswagen in Germany and all their subsidiaries. Volkswagen and its subsidiaries has about 5,000 suppliers. These suppliers, on average, also have more than 1,000 suppliers, so-called tier 2 or second tier suppliers. 5,000 times 1,000 would be 5 million. How many companies can make a particular item of a door of a car or can make a particular valve for a motor? So the question now, and this is now for I try to reach not only the finance people, also the non-finance crowd. Do you have to anticipate longer-term disruptions in your supply chain, even when life is back to normal? What are the long-term consequences there? Now, you may ask, oh, companies got all their money. What did they do with them? Maybe they did something really great R&D and they're ready to go and get out of the crisis. Look at these numbers, my dear friends. Look at these numbers. This was shocking when I read this. By the way, here, this HBR article you can read for free. It's open without a password. Homework for everyone. Take a look at this. This came out in January. It's almost already old now. Look at this. Only 43% of companies in the S&P 500 recorded any R&D expenses. When you read European newspapers, you always say, oh, Asia is so innovative. US is so innovative. Look at Silicon Valley. Look at the Googles, the Facebooks, the Netflix, the Apples. They are so, yeah. Yes, that may be true. But 43% of companies in the S&P only did R&D. That means 57 didn't do any R&D. 38 companies out of 500 accounted for 3/4 of the R&D spending. So they didn't get out these loans because they had these great ideas for new products. No, they bought their own shares back. Here we see, this chart is from this HBR article. We see here in 2018, the 373 companies that were in the S&P for 20 years had share buybacks from more than 600 billion. In total, the S&P 500 had more than 800 billion. In 2019, that number already went down. It was going down because companies already saw trouble. JP Morgan estimates that about 30% of these share buybacks were funded with debt. So here's what's happening. People are taking on debt, not to invest, not to make it a better company. No, to buy back shares. Why is that? Because of crazy incentives. If I'm the CEO or the CFO of one of these companies, my bonus may depend, for many of them, on how the stock goes up. So for me, as a key decision maker in the C-suite, I have an incentive to crank up the stock price. How do I do this? I borrow money, buy back shares to increase the demand. I'm demanding shares and taking supply permanently out of the market and keeping it. And that's why companies are doing this. Share buybacks versus the free cash flow, defined a little differently here than EBITDA, for those who want to know the details, more than 100%. So from the free cash companies had, they spent more on that on share buybacks. The cash reduction by non-financial markets in the year ending Q1 2019 was 272 billion they took out of shares. So now, I don't want to say share repurchases are bad in general. No, they are not. They actually can be very, very good. If you're a company like Apple, like Exxon, like Microsoft, and you are making loads and loads of money, it makes sense to buy back shares. Apple is a cash cow. They make insane amount of money. They don't need all this money. They don't have that many ideas. So over the last 10 years, from 2010 to 2019, Apple bought back shares at 240 billion US dollars. They return money to shareholders. They increase earnings per share. The number of shares outstanding gets smaller. So this is a metric that finance people look at, earnings per share. This supports the stock price. And in some countries, there are clear tax advantages for share buybacks versus dividends. So if you make a lot of money, this makes sense. Quick aside, notice that Apple is estimated, I can't give you an exact number. Here I have to be careful. I couldn't back this up. I only read this somewhere. Apple's activities in its own shares counts for up to 4% of traded Apple shares on any given day. So one of the reasons Apple went so up these last years is because they are 4%. On the margin, they are a key buyer. So again, One thing I also should say, quick aside, when I bitch here about some bad behavior of companies, don't think I'm a commie. I'm neither left nor right. I'm a middle of the road guy. Both these extremes are all wrong. Here I say share purchases are good if you can afford them and if you make a lot of money. Now let's show me some bad people, some bad guys. Here now we have cumulative free cash flows and buybacks in billion US dollars over the same 10 years. I show you here the 5 airlines in the S&P 500. The number 6 airline is an airline called Jetblue. It's not in the S&P 500. Why do I show you these airlines? Because they come out now and demand money from government. They want to be bailed out. And here's my personal favorite. And for those of you who want a guess, American Airlines is going to go broke. They're going to go into Chapter 11 bankruptcy soon. Look at these guys. They had a free cash flow in those 10 years. Combined, how much money did they make after interest rate payments and capital expenditures? They made minus 8 billion. They found 13 billion to buy back shares. Can you explain to me the sense of that? Yeah, of course. If I'm the CEO or CFO of American Airlines, I need to prop up the shares. So these gangsters now want 50 billion from the US government as a bailout because they weren't prudent here in the last 10 years. Now, in addition, Boeing, okay, they made a lot of money, 60 billion, but they also spent 43 billion, about 3/4 of that money on buybacks. And so now they don't have cash. Ha! And Boeing is even arrogant. They said, we want gift. They don't even want to pay a decent interest rate or no stocks. The government can't hold stocks in my company. And that's ridiculous. But of course, Boeing is going to get bailed out because they're important for the military industrial complex in the US. They're critical, so they're going to get a lot of free money. To summarize, cheap money is dumb money. We saw a lot of people who are desperate to invest. They went into high risk, not perhaps really understanding the high risk. Companies reduced cash holdings. I can understand that that was very unattractive for the last couple of years, because if a company like Apple sits on billions and billions and billions of cash, that has very low returns. And the debts were very cheap, so they got increased their debts. However, they didn't do much R&D. They repurchased shares or paid dividends. The EMBA students had an exam, the December 2020 class had an exam where I showed them what happened to Kraft Heinz, the ketchup company. They paid dividends even though they were doing lousy, and then they got punished by the rating companies. But they still had to pay dividends to make the shareholders happy. So that's really annoying. And so this is sort of the fuel, the gasoline that's firing up this crisis and makes it much worse than we would have seen otherwise. We are in danger of destroying ourselves by our greed and stupidity, said Stephen Hawking. Now, the first casualties right now we see in the oil and gas sector. Why is that? The last couple of months have seen a price war between OPEC and in particular Saudi Arabia on the one hand and Russia on the other hand. And they're now flooding world markets, total overproduction of oil. As a result, producers with higher cost, such as the so-called shale producers in the United States, are under a lot of pressure. So they see declining revenues, actually prices below their cost. One of those companies is a company called Viking Petroleum. I must say they were not that bad about share buybacks. They had a little bit here and there, but not big time. The 52-week high was about $31. 10, 11 months ago, it was still above 25. Last night, they closed at 36 cents. So this is now a company where we see declining revenues, cost, and so they're in trouble. And let's look at the cash and debt situation. So greatly reduced revenues, they, in last week of March, they still got a credit from a bank. What were these bank people thinking? Don't give them a credit anymore. The loan, the money is gone. But no, they got a $650 million. They had $2.4 billion in outstanding bond debt during the next 6 years. Remember the picture I showed you earlier, the refinancing. So these poor guys have to refinance $2.4 billion in the next 6 years. Guess what? On April 1, no joke, they had to refinance $260 million in a bond. There was an option to convert it in stock, but the bondholders didn't want to go for this, and they didn't have the money. And after they had burned the $650 million already, there was no money left, and nobody wanted to give them money. Bankruptcy, game over. And so they filed for bankruptcy. So now the bondholders of those $2.4 billion, they're going to get creamed. Stock market, what happened to the shareholders you saw, they are in dire straits. Now you may not have heard about Viking Petroleum. Here's another guy. Occidental Petroleum. I had never heard about them until last year when they did this monster takeover and Warren Buffett got them a lot of money. And this shows you now that even Warren Buffett sometimes screws up. This is the largest US oil producer, Occidental Petroleum, nicknamed Oxy. Last year, money was cheap. Remember, money was cheap. I barely touched on M&A. Anadarko Petroleum had an offer on the table by a company called Chevron for $50 billion. $50 billion. Chevron said, we buy you. All they had to do was sign. They had agreed on the deal. And then in the last minute before 12, last minute before high noon, Occidental said, what's $2 billion? What's $2 billion? We give 10% more. With money from Buffett, they did a $55 billion takeover after this bidding war. So look at what happened on March 25th. Moody's downgraded them to junk. This is now one of these companies that was high, had still a good rating in the BBB, BBB area, and now was downgraded. 40 billion in debt, 3 billion in cash. They were trading a bond that was paying a coupon of 3.18%. It was trading at close to par a little bit. So the so-called yield was a little less than 3%. And then comes the downgrade. Now, I wish we all had bought at 51. We would have made a quick 40% here in a week or so. So they now have to refinance their debt. And they're going to be in a lot of trouble. Now, Buffett, of course, is really smart. If they can't pay back the loan that Buffett gave them, Buffett will essentially take over the company and it will belong to Berkshire Hathaway. However, along the way, he will also have lost a lot of money. Now, there are other big names. Ford, so-called fallen angel. Fallen angel are these companies who go from a good rating, investment grade rating, to high yield to junk. And I could show you other pictures of these now. I don't want to bore you with too many statistics. You see now the same happened to Ford. Also in dire straits now. And if they have to regrade, they have to pay much higher interest rates than the 4.3% they paid a couple of years ago. Now, again, I showed you a lot of data from the US. Yesterday, the Financial Times reported about a company, a breakdown service called AA. I don't know them, but I trust those of you residing in the UK may know. And they are in huge trouble. And here, the same telltale signs of what we see. High leverage, so people taking on a lot of debt. Low interest rate coverage. This is another metric that says how much money do I make to pay my interest. Low coverage means I barely have enough money, and poor profitability. All bad. And so how did this happen? Some gangsters, a private equity group, bought them, restructured, loaded them up with debt. And what did they do with the debt? They cashed it into their pockets as dividends. So greed, greed, greed. These guys are going bankrupt now or soon. With respect to these fallen angels, just to give you a flavor here of magnitudes, Deutsche Bank says we saw 90 billion got downgraded in March. So if these need to be refinanced the next couple of years at higher rates, they're in trouble. Bank of America estimates right now 200 billion. I think that's a joke. It's not going to be 200 billion. It's going to be 2-3 times that. It will get much worse. So government's reaction, if you're following the news, you have heard about this, the US CARES Act. They want to give 2 trillion, but because of a dysfunctional government in the United States, they have a hard time giving out the money to small companies and to private people. 50 billion are a loan for the airlines. Boeing is demanding 60 billion for themselves and other airplane manufacturers. So we see a big government, and a lot of that money, I'm not sure whether the government will ever see this again. This is subsidies. They call it loans or whatever, forget it. More than 500,000 European firms, not people, firms applied for payroll subsidies, the short time that we have in Switzerland, Germany, and many other countries. The Economist estimates the total value of these packages so far at 13.5 trillion. And again, there's more money out there. As I told you, Dubai and Singapore bailing out their prestige airlines. So we see historic moment in humanity, the largest business handout of all time. Now, here's something interesting. The policymakers are not stupid. Here I show you text from page 500 something from the US CARES Act. This is this bailout act that came into law 10 days ago or so. The policymakers knew what was going on. If a company now takes debt, so if Boeing takes money, gets bailed out by the US government, they cannot buy back shares. This is what the first legalese says. And they cannot buy dividends until the following moment. They get money. Hopefully we get out of the crisis. They pay the government money back. And then they have to wait 1 more year until they can pay dividends and they can do repurchase of shares. Of course, Boeing says, oh, no, we are Boeing. I'm not going to do this. This is ridiculous. Now, Trump already reacted. He fired the guy heading the oversight committee that makes sure that this is all done by law. So corruption is going to run wild, as it always is in these kind of situations, particularly, of course, in a lawless economy like the United States. So we're going to see here massive bailout. Now, to summarize, things are really bad because of the virus. However, there was already a lot of dry powder and gasoline out there, the crisis waiting, the crisis hits, and now kaboom, we have the explosion. Companies need cash, cash, cash. And suddenly all these capitalists becoming commies and asking for a government bailout. But that's what will happen. Now, what you want to think about? Your company, do you want government money or perhaps go to shareholders? Yeah, issue new shares. Now, I know it's not fun right now to issue new shares at lower prices than 2 months ago, but that's what stock markets are for. Stock markets are to generate cash for companies that they can spend on R&D, on liquidity to get through the crisis, on perhaps buying their supplier and making profits later on. Yeah, so why not issue new shares? Private equity, as I told you, they will come in, they will buy companies, we will see takeovers there, we will see M&A activity. These seem to me more market-driven solution as is government bailout, but the companies are all running to the government. Now, be fearful when others are greedy and greedy when others are fearful, said Warren Buffett. Warren Buffett is sitting on 125 billion cash. He underperformed the market last year. So there was even criticism of the legendary Warren Buffett, who is, for those of you who don't know him, he's sort of a legendary investor in the United States. His net worth is estimated to be 30-40 billion. He is giving all his money to the Gates Foundation. And he, I'm sure, is looking right now for good investments. Occidental, he went in there way too early. He's also gave money to Kraft Heinz and got burned there. So clearly some people are already buying shares right now. We have seen this in the recovery of markets. Personally, I think we are too early. Now, I know some of you want to know where's the stock market going. I have no clue. Bob Shiller doesn't have a clue. Bob Shiller is a Nobel Prize winner, economist. He's very interesting. He's one of the very few academic economists who has something to say that's relevant to the real world. Yeah, most of academic economics is all BS and academic nonsense, but Bob Shiller has something to say. And he says, is the market cheap today? Is it expensive? He says his answer is it's not as expensive as it was just months ago. Yeah, that doesn't help us. Read his article if you want an expert. He's very careful. I believe the market is still overpriced. I still believe there's a lot of optimism in there. We still see the virus getting worse in some countries, in particular in the US. And I don't think Americans have fully understand how bad this is. And some people still think it's a hoax. Personally, back to the V-shaped recovery that we will see a quick turnaround. I don't see this because there's long-term damage. When companies go broke, and even this Chapter 11 in the US, where companies can get out of bankruptcy again after a couple of months, after restructuring, that slows down these companies. For example, if your supplier has a patent on an important piece that you need, that patent also ends up in bankruptcy courts. So some judge or lawyers have their hands on that. What does that mean for your supply chain? What happens if that gets sold in that bankruptcy restructuring? So I think we're not going to have a V-shaped recovery. Now some people say it's U-shaped. We're going to be longer down for a while and then it goes up. Hopefully. But what we make in this, what we write, Rob Earl is a friend of mine and a consultant from the US. Jung is a great research talent here at IMD. We published yesterday an article in the conversation. And we think there's a prolonged slowdown. I hope we are wrong, and we're saying this. We don't want to be right. Now, with respect to government bailouts, I am not a fan of giving money away to companies who were irresponsible in the past. So together with my postdoc mentor from Stanford, I wrote a little article that appeared by the Initiative for Global Markets at the University of Chicago. Both of these articles are free to read, so please have a look at them. What governments should do is get shares for their investments for the bailouts in the Boeings and American Airlines of this world. Why are we saying this? We want these shares to be non-voting shares, meaning we don't want government bureaucrats to run companies or have a say. So, however, we want to set the right incentives for the company. If Boeing right now gets these shares, they don't like that the government owns part of the company. We want to motivate them to work hard, to clean up their finances. And once we have cash, get out the government, and for the government to make a solid profit. The government deserves, the taxpayer needs to be protected and deserve to get some profit in the bailouts. Why is that? Because some company will go under. Some of these loans or hopefully stock will be worthless. So the government will lose money on some investments. They may need to make money on others, hopefully to come out positive in this. So I'm not, I know this will not happen. This will be completely ignored. But really what should be happening is that these irresponsible companies should have to give part of the pie to governments. Now, I saw some question is on what's going to happen to the US dollar. Some people are worried about the dollar will devalue because of that 2 trillion bailout. It will become a weak currency and there's too much debt in the United States. My answer to that is no, I don't believe this. And here's why. Look at Japan. Japan's debt relative to GDP is between 230 and 240%. So Japan is hugely in debt. In the United States, this number is between 80 and 100%, depending on how you calculate. Let's say it's 100%. So the US could double its debt and still be better off than Japan. Now, both Japan and US dollar are in a very lucky situation that they take on debt in their own currency. Most of the government debt in Japan, not everything, but the vast majority of it is in Japanese yen. So the income of the government is in yen, and the payments of interest and taking out new loans is in yen. The same is true for the United States because they have the world's reserve currency. So they're very lucky there. It's different if you look at a country like Argentina, which frequently goes broke. Argentina has a lot of loans in the dollar, but their income from taxation of businesses in Argentina and so on is in pesos. So essentially, they are doing a play on currencies. Technical expression is carry trade. You may have heard about the carry trade. So then, if the dollar appreciates against the peso, kaboom, they go broke. And we see this a lot. It's also the case that both in Japan and the United States have fairly low taxes compared to many other companies. So these countries could increase the tax burden. Of course, there would be some negative implications of that, but still, they could increase the tax burden and increase the income to the government to pay up debt. So therefore, for those of you who are really worried about the US dollar, I don't see this. Personally, I'm more worried about the euro. Why? Because once we are out of this crisis, there will be a renewed look at the debt of some of the more indebted euro countries like Spain and Italy. And so I am there more concerned about the euro. So also sometimes, I haven't seen it yet, the question of hyperinflation arises of all the money that is printed. We don't yet have enough money printed and given out to really get into inflation. In the United States, there's already talk about a phase 4. Maybe if more and more money is printed and pumped into the economy, if this virus stays for us until June, July, or if there's this big second wave coming next fall, yes, maybe we're there. Currently, we're not there. It's really more that we see a lack of demand. Remember all these unemployed people, the people are stopping on saving. We see a lack of demand for goods, and it's more like deflationary. So for the time being, I don't see hyperinflation or anything. So now Q&A, let me see, there were a ton of questions now. I'm going backwards. Sorry, I can't tell you about Saudi Arabia. I hope for their sake that Saudi Arabia and Russia will get in an agreement on the oil price so that they can stabilize the oil price. And I think that will be good for many, many countries, also those who are in gas exploration. However, of course, for us customers here, it's great. Here in Switzerland, the gasoline prices at the gas stations have come down. Why? Because we have this overproduction by OPEC and Russia on the one hand, and then people are not driving to work. I'm not allowed now in the Easter break to go into the mountains, so we are driving much less. So demand has gone down, production has gone up, prices have crashed. So if I had a big gas tank in my garage and I were allowed to store my gasoline for the next 2 years, I would buy like crazy right now. Will there be a going back to the gold standard? No. So I know some people always say we have to go back to the gold standard. That's just impossible. There is not enough gold in the world. So the gold standard was given up in the early 70s. In the meantime, the amount of money has grown so insanely. There's so little gold. Some of you may have heard this. the entire gold ever gotten out of the ground and made and cleaned up in gold is fits into an Olympic swimming pool. So the gold would have been so insanely expensive. We cannot do that. Now, interestingly, gold has gone up a little bit, but not as you may have expected, that it goes up by 20, 30, 40%. Interestingly, when we see a big crash, in those days when we see a really big market crash on equity markets and bond markets, gold also goes down. Makes no sense, but here's the explanation. It's partly a behavioral explanation. Big investors that have stocks, bonds, real estate, and gold, when some of these professional investors are on margin, meaning they take on debt to invest, now they get so-called margin calls. The bank says, we need to see money. You invested so much, your investments have lost so much value versus your debt. Show me some. Either you have to sell the stocks you're now losing money on, or you bring in money. So then people have the tendency to sell winners. And if gold had gone up, then they start to sell gold. So if you look at the worst days in March, gold went down. If you go back to the 2008-2009 crisis, in the worst days, gold went down too. It's only that a couple days afterwards we see an increase. We saw a bit of an increase of gold, but not the kind of stuff that you would expect in a monster crisis. Emerging markets, I don't know enough, so I have to be very careful about emerging markets. But there's a lot of debt in emerging markets, so increasing interest rates there as well. So will see a lot of trouble there as well. The only good thing for emerging markets is that what happens in crises is that there's this rush into so-called safe haven currencies, which appreciate in value. So for the export of emerging market economies, their export goods have become a little cheaper. But I think the emerging markets are affected by this as well. So the idea, will we avoid the US as a reserve currency? I don't think so. People have been dreaming of this for a long time. People have been dreaming of that the trade currency, the reserve currency, could be the euro, could be the yen, the renminbi. It hasn't happened. Someone, a PhD student from my Kellogg days more than 15 years ago, she works for the Bank of Thailand, and she said Asia is hooked to the dollar. All the trading is done in dollars, so we will see more. She doesn't see it coming. India's debt to GDP, I would have to look it up. So there are now some really specialized questions that unfortunately I don't know. Shoot me emails. I'm happy to do the research for you. So an L shape, yes, that will be more likely. Where does all the money the economy now need come from? From Alexander, the source. So now, careful. Here now, there was already a lot of money parked. So Jean-François Manzoni, the IMD dean, he, of course, frequently talks to CEOs, CFOs. And so he also talked to people from UBS. UBS is one of the largest, if not the largest, wealth management bank company in the world. And the people from UBS told him, and he told us this in January at a community meeting at IMD, that 40% of people's investments was in cash or short-term investment. 40%. So a ton of investors were worried already and were holding back cash. So there is a lot of cash out there by key investors. And that may explain that a lot of that money is already going back into the markets. Why we have seen this quite impressive recovery. So it's not just coming out of the government. There is a lot of private money. And so some people, if you remember back to the financial crisis, when first there was a big also government bailout there, some people said, we will see inflation, we will see inflation. We didn't see any inflation the last 10 years in the developed countries, very little. And the reason is a lot of that money stayed with some investors, not with the companies, because they were pushing up their stock. But so there is still a lot of cash out there that appears to be coming in. Iran, yes, Chapter 11 bankruptcy is reorganization. That's absolutely right. U.S. bankruptcy law has a Chapter 7, a Chapter 13, and a Chapter 11. Chapter 11 is a type of bankruptcy where they do a reorganization. Some debt is lowered. Some people take a cut. But the idea is that these companies can survive. So to what extent can governments not bail out companies? So there is, of course, governments are very precious. So, for example, Boeing is very important, as I said, to the military. The US government cannot afford to let Boeing go out of business. They don't want to be dependent on other companies and other countries to make military jets. They also want a little bit of competition still, even though the game is rigged. They want a little bit of competition when they have a big defense contract. So, and Boeing employs a lot of people. So it's very difficult for governments. So there's a lot of public pressure on bailing out these companies. You see it, for example, in Germany. In Germany, there's a travel company, TUI, T-U-I, that's operating in many European countries. They got 2 billion euro bailout from the German government. Now, if you look at the airlines, I mentioned already Singapore and Dubai. There's a lot of pressure on the German government to bail out Lufthansa. Italy essentially nationalized Alitalia. The Americans airlines are creating a lot of pressure on in Washington to get bailed out. Iran, yes, American is one of the worst carriers, crappy service, old airplanes. Yeah, guess where the money went? It went to share buybacks. Yeah, they should have put that money into better airlines. So, yes, so again, but people want to go to Cancun or Hawaii after all this is over. So there's public pressure also to keep these airlines above. So, people, there's still more than 400 of you. I'm 15 minutes over. I get in trouble with IMD. Thanks for all your questions. I'm very sorry I can't do justice to them. My email address is karl.schmedders@imd.org. I love to hear from you. Maybe I said something wrong. Maybe one of you has special knowledge about your home country. I want to learn about this. Shoot me emails. I will try to reply. I loved this session. If you liked it, tell IMD. We do another one in 4 weeks, in 6 weeks. Markets are happening quickly. The real economy is changing by the minute. I haven't talked about currencies, what's going on there. I haven't talked about gold, many metals. We could have talked about so many other topics. I'm really, really sorry. I see here blinking questions, chats. I'm already over. Thank you. Good night to you in Asia. Good evening in India. Have a good day, rest of the day in Europe and Africa and in the Americas. I love to hear from you. Be safe, be well. Please think of IMD, hold us dear and well. And thank you. Really, thank you a lot.